Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden within corporate filings. Today we're diving deep into G Group Inc.'s latest annual report, the 10K, and let me tell you, this one has some interesting twists and turns in the world of staffing. Get ready for a financial rollercoaster as we uncover their strategic moves and the risks lurking beneath the surface. Before we jump in, if you love getting straightforward insights from these powerful documents, don't forget to hit that subscribe button. We also have a thriving community over on Discord, link in the description below, where we break down these reports together. So check that out. Alright, so we are looking at G Group Inc.'s annual report for the fiscal year ending the 30th of September 2025. Now, this is a company that provides staffing solutions, essentially helping businesses find people for jobs, both temporary and permanent. It is a competitive industry, and they've been making some strategic moves like acquiring Hornet Staffing Inc. in early 2025. They paid about $1.5 million for it, which included some cash and promissory notes. This acquisition they hope will boost their presence in working with large clients through vendor management systems. Now let's talk numbers, because that is where the real story lies. For fiscal year 2025, their total net revenues were about $96.5 million, that is down from $106.9 million in 2024. This is a 10% drop year over year. Their main revenue comes from contract staffing services, which saw an 11% decrease. While they did acquire Hornet, which contributed some revenue, their overall business volume seems to be down. This decline is actually higher than what industry analysts like SIA predicted for the staffing industry as a whole, which saw about a 3% decline in 2025. This suggests that G Group might be facing even tougher headwinds than the average player. The good news is their gross profit margins are actually looking okay and even slightly improved. Their combined gross profit margin was 34.6% in 2025, up from 33.8% in 2024. This improvement is mainly because of their direct hire placement services, which have a 100% gross margin. Think of it this way: for every dollar they earn on direct hires, almost all of it is profit, because they don't bear the payroll costs like they do with contract staff. However, their main revenue from contract staffing services saw its gross margin stay pretty stable, around 25.5%. This means while they are generating profit on their contract services, the overall decline in that business line is still impacting their total earnings. Now let's look at their expenses on the selling, general and administrative side. SG&A decreased by about $4.2 million in 2025 compared to 2024. This is a positive sign indicating they are cutting costs. SG&A as a percentage of revenue was 36.9% in 2025, which is slightly better than 37.2% in 2024. They've been focused on streamlining operations and reducing costs, which is crucial when revenues are down. Here is where things get a bit concerning. The company recorded a massive Goodwill impairment charge of $22 million in 2025. This is a non-cash charge, meaning it is an accounting adjustment to reflect that the value of their acquired businesses is worth much less than what they paid for it. They also had a $14.2 million Goodwill impairment in 2024. This signals that their past acquisitions are not performing as expected, and their values have significantly decreased. You can't find this in the financial tables. If you scroll down you will see the numbers for 2025 and 2024. It was $22 million and $14.2 million respectively. This is a big red flag indicating potential overpayment for acquired assets or a significant downturn in those acquired businesses. All these factors, like declining revenues and massive impairment charges, have led to a significant net loss. For fiscal year 2025, the company reported a net loss of $34.7 million. This is worse than the $24.1 million net loss in fiscal year 2024. The impairment charges and a large valuation allowance on their deferred tax assets significantly impacted these results. Essentially, they are not generating enough profit to cover their expenses, and a lot of that is due to the accounting adjustments for the diminished value of their past acquisitions. On the cash flow front, things are a bit mixed. They generated $549,000 in cash from operating activities in 2025, an improvement from $202,000 in 2024. This suggests they are managing their working capital better or collecting cash from customers more efficiently than before, even with lower revenues. However, their investing activities show they spent about $968,000 on acquiring Hornet Staffing, and proceeds from selling their industrial segment were about $1 million. So they are actively managing their business portfolio, buying and selling parts of it. Now let's talk risks, because every company has them, and G Group has quite a few detailed in their risk factors. One of the biggest challenges they face is the rapid advancement of artificial intelligence, or AI. AI can automate many tasks traditionally done by staffing agencies, potentially disrupting their business model. They acknowledge this threat and state they are integrating AI into their strategy and focusing on placing AI talent. Another major risk is their reliance on debt. They have a $20 million revolving credit facility, and the terms of this agreement could restrict their operating and financial flexibility. Failure to meet covenants could lead to acceleration of repayment obligations, which could seriously harm their finances. They also have significant intangible assets like Goodwill and customer lists. These are subject to impairment risks. As we saw with those large impairment charges in the financials, this is a very real and present danger for them. If their future projections for these assets do not materialize, these impairments could continue to hurt their financial results. And of course, the economic environment is a huge factor. The report highlights persistent inflation and high interest rates that can reduce client spending and hiring. They are already seeing a decline in business since 2023 and warn that worsening economic conditions will continue to negatively impact them. On the property front, they lease all their office spaces. This is common for staffing agencies as it provides flexibility to open or close offices based on business needs. It is a smart strategy to avoid being tied down with expensive real estate when business can fluctuate. Looking at the stock market side, their common stock is traded on the NYSE American under the ticker JOB. However, the report warns about volatility in their stock price and the potential for it to decline regardless of their operating performance. They also mentioned that a more active and liquid trading market might not develop, which could make it harder for shareholders to sell their shares. When we look at their capital structure, they have authorized preferred stock, but as of September 2025 and 2024, no shares of Series A or outstanding shares of Series B and C preferred stock were trading. This suggests they've managed to steer clear of issuing significant amounts of preferred stock, which can sometimes dilute common shareholder value. Diving into the balance sheet, as of the 30th of September 2025, GE Group had about $21.4 million in cash. That sounds like a decent amount, but remember they have those ongoing operational expenses. Their total current assets were around $31.7 million. On the liabilities side, they had about $7.7 million in current liabilities. This means their working capital, which is how much cash they have readily available to cover short-term expenses, is approximately $23.9 million. This is down from 2024, which might be a slight concern, indicating less immediate financial flexibility. The big story here is the Goodwill, which dropped significantly from $46 million in 2024 to about $24.8 million in 2025 after those impairment charges we discussed. Looking at the income statement again, we see that significant net loss of $34.7 million in 2025. The revenue decline combined with those impairment charges really hit them hard. Their loss from operations before interest and taxes was already a substantial $25 million before even considering taxes and interest. The statement of cash flows is interesting. They generated positive cash flow from operations, which is a good sign showing they can bring in cash from their regular business activities. However, their investing activities show they spent money on acquisitions, and their financing activities were mostly related to stock repurchases in prior years. Delving into the notes to the financial statements, we find more details. For example, the company uses a lot of estimates in its financial reporting, particularly for things like expected credit losses. On accounts receivable, they adopted new accounting standards for credit losses which didn't materially impact their financials, but it shows they are adapting to new regulations. In the income tax section, we see that large valuation allowance of over $12.7 million. This means they don't believe it is likely they will be able to use their deferred tax assets to reduce future tax payments. This is often a sign of past profitability struggling to return. Their loan agreement is important. They have a $20 million credit facility which they have not drawn on at all in 2024 and 2025. This can be seen as a positive, as it means they are not overly reliant on debt for day-to-day operations, but it also means they might not be seeing it as a critical need, which could point to current cash flow constraints. Looking at shareholder equity, we see that they have been granting restricted stock and stock options to executives and directors. For instance, Derek Dewan, their CEO, was granted restricted shares, while Kim Thorpe, their CFO, has outstanding stock options. This is a common way to incentivize leadership, but it is important to see how these relate to company performance, which is something we explore in our pay versus performance section. This section highlights the disconnect between executive pay and company performance. For Derek Dewan, their CEO, the compensation reported in the summary compensation table for 2025 was $536,480. However, the compensation actually paid to him, which is a more complex calculation mandated by the CEC, was $519,755. The table also shows net income available to shareholders, which was a negative $34.7 million in 2025 and a negative $24.1 million in 2024. This is a classic case where pay may not directly reflect the company's bottom line performance, indicating a potential disconnect for shareholders. They break down their business by segment, and their professional segment is where all the action is. Their industrial segment was sold off as a discontinued operation. This shows a strategic shift focusing on their core profitable areas. The leadership team is a mix of seasoned professionals. Derek Dewan, their CEO, has a strong background in the staffing industry, with a history of successful acquisitions and turnarounds. Kim Thorpe, their CFO, has extensive financial experience, and Alex Stuckey, their COO, brings operational expertise. These individuals are crucial for navigating the current challenges. So what is the verdict on GE Group Inc.? They are in a tough industry facing economic headwinds and the disruptive force of AI. Their revenues are down, and those goodwill impairments are a serious concern, suggesting they may have overpaid for past acquisitions. However, they are showing signs of cost control and generating some positive cash flow from operations, which is a silver lining. Their strategy of focusing on professional staffing and shedding their industrial segment is sound. The pay versus performance data also raises questions about the alignment between executive compensation and corporate results. My take is that while GE Group is making some smart strategic moves like cost reduction and focusing on core segments, the significant goodwill impairments and declining revenues paint a picture of a challenging road ahead. The success of their AI integration and ability to find new growth avenues will be key. They need to demonstrate consistent profitability and efficient operations to regain investor confidence. It is a company in transition, and the next few years will be critical to watch. Alright, that is our breakdown of GE Group's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.